Kevin Recher here. In today's video, I'm going to go over the 4 different channels of which you can go to actually get a mortgage. That's right. A lot of people don't understand that there are 4 different channels. A mortgage broker, such as myself, a bank, credit union, and correspondent lenders. They all originate mortgages for you. They all have pros and cons, and I'm going to get into it because understanding the pros and cons can be the difference between costing yourself thousands of dollars or potentially saving thousands of dollars. So let's get into it. First and foremost, I'm a little bit biased. I am a mortgage broker. I've been in business for 30 years. 30 years originating as a mortgage broker. There's more truth in lending with a mortgage broker. We are loyal to our clients. We're licensed through the SAFE Act, and we must disclose how much dollars we actually make doing a deal. We disclose it one of 2 different ways, right? It's either a lender paid transaction or a borrower paid transaction, but we have to disclose the dollars associated with each of those, okay? We have 20 to 30 different lenders. So if we're shopping 30-year fixed, we may have 20 different 30-year fixed that we're actually looking at, and we're trying to get you the best deal that also meets your timelines. Just because there are times that I can't use my very best lender because a realtor negotiated 15 days and I need 20 with a certain lender, right? So just in general, I'm picking a lender that meets your needs always, and the one that also has the best price also. Banks, the loan officer is loyal to the bank. He works for them, no national exam, and he does not have to disclose the profits, nor does he even know what the profits is. He only knows how much he's making, right? The bank does not have any caps on what they make. A mortgage broker, the maximum any mortgage broker could make on a deal is 3%, right? There is no cap on a bank. They don't have to disclose how much they make, nor do they. Okay. Now, one of the big differentiations with a mortgage broker, right? He's also setting his own price. So in my case, I work for 1% or less of the loan amount, right? The loan officer, he might make 1%, but the bank may want to make 3%, and none of that gets disclosed to you. Okay. Correspondent lenders are kind of a hybrid model, okay? They can have some loans that they broker. They can have some loans that they're the lender, but they mainly use a warehouse line of credit to actually fund the loans. And then they'll either send it to that one or send it to that one, right? The thing about it is he may have 20 different sources, but he may only have 2 that they use for the warehouse line. So he's always going to use this one whenever possible to make more money. The only reason someone goes correspondent generally is a mortgage broker can go correspondent is to make more money and hide what they make. They, like a lender, do not have to disclose how much money they make on a deal. And that is the primary reason that they went correspondent. The thing about it is they're going to sell your loan within 30 days, typically. Okay? They're going to sell the loan. They're not going to hold the loan. And if there's any problems with the loan, the bank that was going to buy the loan says, no, we don't want it. It gets stuck on that warehouse line, and you're dealing with this lender until he can figure out a way to get rid of that loan. Personally, correspondent lending, there's a lot more risk. That's why I personally chose not to do it, okay? Credit unions, you have to be a member, right? They're typically slower. They make their own rules. The membership required, no national exam, and they do not have to disclose how much they make either. They don't know how much they make. They're getting their money from their other members, okay? So in general, they could have a product that none of these guys have that suits your needs, but understand that you're gonna go at their timeline and their rules, okay? So those are some of the key differences between them, right? So when I would start talking about the benefits of each of these channels, right? So mortgage broker, access to dozens of lenders, right? Dozens of lenders, so try to get you a best rate, right? The owner controls the price. So in general, the owner gets an interest rate and a cost associated with it, and he adds a percent or a percentage or dollar amount to that number. He could add $1,500 to the wholesale price. He could add 1%. He can do whatever he wants, but whatever he sets his lender paid price at, which mine is at 1%, he can never make more than that. Even if he goes borrower paid, it has to be less than that. So that's why we are capped, and the borrower paid options are never more than the lender paid options. So it is always less, or it can be the same, but it's never more, okay? On average, brokers over the lifetime save people over $10,000 on the loan versus the other products. I know that that's a lot more. They're basing that on national averages and not someone that's priced at 1%, okay? Banks have recognition, brand recognition. Sometimes they can have portfolio products. They often hold the servicing, which a lot of people like, right? But the biggest thing is the loan officer cannot negotiate the price on a loan at the bank, right? So what happens is you have a loan officer over here, right? And he wants to give you a better deal. So typically he has to talk to his sales manager and say, I want to give Joe a better deal, right? And the sales manager says why, and he asks for the reasons, because he's got to make sure that he's not giving one person a better deal and not another. And then he's got to then go to secondary that sets the price, secondary market at the company. And then the secondary market person then has to go back to the manager and say, okay, I'll give a better deal. And then the manager gives a better deal to the loan officer. So all of this has no flexibility when it comes to price. This loan officer has to go through typically 2 layers, and then that has to work its way back. And typically they might ask for a better deal at 10 o'clock, and they may not get an answer until 5, 6, or the next day. Right? So no flexibility for the loan officer when it comes to that, but they do hold servicing. Correspondent lender, they have variety, much like a mortgage broker. They have multiple relationships, potentially just as fast as a mortgage broker. The loan closes in their name, but here's the thing is they have to sell it. They have to clear off that warehouse line so that they can do the next deal. So sometimes things get muddy in that speed. So they're not required to disclose. That's the only reason that people become a correspondent lender, is so that they can act like a bank, so they can hide what they make. They have no caps on what they make unless they do it as a broker. Same here, no caps on how much money they make. This mortgage broker is capped at 3 or whatever his lender paid compensation is, and mine is 1%. So if this person can make as much money as they can, and this person can make as much money as they can, and this credit union can make as much money as they can. Where is the only place that there's an actual cap and disclosure on pricing? Right here, as a mortgage broker. Okay, so I'm going to get into the next slide. So here on this slide, we're going to go through some of those differences. Mortgage broker, he does not fund his loan. A bank does, a credit union does, and a correspondent does. All right, so in most cases, that shouldn't matter, right? Funding your own loan as a loan officer is only positive if somehow I have better speed and I can talk to underwriters, but I can talk to underwriters as a mortgage broker. And most of the banks and credit unions have gone to call centers for cost savings. And the loan officers have to then call the call center and get everything taken care of through them. Their processor might be there, it might be centralized processing. So in general, I think a mortgage broker with a good relationship probably has more negotiating power and ability to get things done faster and talk to his underwriters as a bank or correspondent lender or a credit union in some instances, right? So multiple lending sources. Broker might have up to 30. These do not have, the bank and credit union typically have one source, and then this one may have multiple sources also, the correspondent lender, okay? Must disclose compensation. Every penny here gets disclosed. No cap on what they make, no cap. And this is a maybe at a correspondent if they're brokering only, okay? Have to take an exam. They don't at the bank, they don't at the credit union, they might at a correspondent lender. Owner decides the pricing and can negotiate on the loan officer side on what they're charging you, okay? Management and secondary decide here, so no chance there, no chance there. Maybe on the correspondent side. You get a lot of maybes on that correspondent side, right? But next, let's talk about compensation caps. We have a cap here, no cap, no cap, no cap unless they broker, okay? So in general, where do you want to go? The place that has no cap or the place that has a cap? Borrower can negotiate borrower paid comp. You can on a mortgage broker, not on a lender, not as a credit union, not as a correspondent unless they broker, okay? The other thing about it is the average savings versus retail. There was a study done, average broker saves someone over $10,000 over the life of the loan. I know it's a lot more than that, but it was just a study that was actually done, okay? Next slide, borrower paid versus lender paid compensation. As a mortgage broker, I can only get paid from one source, either from the lender or from the borrower. I'm going to try to break that down to you in a very simplified way. I make 1% on my mortgages, right? So I make 1%. So on a $300,000 deal, I would make $3,000 that the lender would pay me, right? So how that works is if 6% as a rate paid 1% in premium, that means that would be a 0-point loan to you. The lender would pay me my $3,000, right? So on a borrower paid transaction, if at 6%, it paid the borrower $3,000 because I can only get paid from one person. So at 6%, these two deals are equal. If I was making my $3,000 lender paid, I make my full amount of money and I cannot reduce that amount of money. If I go borrower paid, the borrower then gets all of this money, and then I have to tell the borrower, on a borrower paid transaction, I might say, I want $2,000. So then the client, which is you, would have $1,000 left over toward your closing cost. So you, in theory, could negotiate a situation. Let's say you had an $800,000 deal. Let's say you had an $800,000 deal, and I was going to make $8,000 on this deal, right? You might say, you know what, Kevin, I want you to work for $4,000. Are you willing to do that? Sure. In that situation, you just made yourself $4,000 by negotiating borrower paid transaction. Now, are all lenders going to do that? No. Most of the time, what we're going to do is we're just going to quote you maybe a half-point deal in this situation, which would be $4,000, and you actually might get 5.875 as a rate instead. And that we might charge you a half, you might get paid a half, so that would be net $0 to you, and you got a lower rate. So by going borrower paid, sometimes you can just get a lower rate, right? And or money, right? But either way, that's an option. Lender paid, we're stuck in a box. But that box is pretty cool for a different reason, right? So I'm going to show you something else, right? So this lender paid, let's say I'm still making 1%, right? I'm going to teach you. So I'm making 1% at 6% as a rate, right? Let's say the rates got better, and at 6% today, it's now paying 1.5%. Remember, my comp is only 1. I can't keep the extra half. You just got paid a half a point by going to a mortgage broker because he can't make more than what his lender paid comp actually is and was disclosed to the lender. So the thing about it is, on a lender paid comp, I have to tell the lender exactly how much money I'm willing to work for in general. Now, 1 to 1.625 is probably the norm, right? If you ask a broker and they say they're at 2 3/4%, then you know he's doing most of his deals borrower paid, and what he's trying to do is figure out where he can get you to decide in general how much money he can make, trying to make his max, right? Going borrower paid and establishing it at a higher level and working down. Now, this guy, he might be willing to work for a half a point. Odds are against it because he's trying to hit one of these other matrices and get paid more money. He may say, oh, I'll work for 2%, right? Or I'll work for 1.5%, right? And ultimately, if you don't know any better, you just think that you're getting a good deal versus maybe you shop someplace else that was at 2 3/4 and he offered you 1.5, and you're like, oh, that's pretty good, right? But that would be no comparison to my deal because if you went with this guy at 1.5, right, and I was at 1, remember the previous slide, I just told you, if we were using the same lender and it was priced at 1.5 and I am at 1, you would actually get the extra half and you'd be required to get that money versus this guy. So fundamentally, finding someone with a low lender paid comp guarantees you better pricing. Has to. Let's go into how a loan officer gets paid, right? So a loan officer gets paid typically in basis points when it comes to the mortgages. He might get paid 0.5% on 350K loan, right? It would be $17.50. At if he got paid 75 basis points, he gets paid $26.25. At 100% or 100 beeps, 3,500 and 125 beeps, for $43.75. If he's a loan officer that gets paid 2%, he's making $7,000 as a loan officer on you, right? So here's the thing: all of these have to get priced into the loan plus overhead, right? At the bank level, that's why they have no caps, guys, right? That's why they have no caps. So they can consume all of this and still be in business, right? Mortgage brokers, we're capped at 3% rule, right? The average commission is going to be between 0.5 to 2.5 in general. And banks don't have an equivalent cap. Broker owners can reduce the fee instantly, right? So there's just more flexibility in going to a mortgage broker, okay? So why shopping with a mortgage broker is easier, right? Is, remember, we went into it, the fact that the lender paid comp is the cap. So what you want to find is someone with the lowest cap from 275 all the way down to 0. So the one who has the lowest cap, which I'm at 1%, is most likely going to be your cheapest deal. Now, a bank can undercut that 1%, right? If they have a better deal, they have a better deal. But the odds are they're not going to do it on a regular basis, right? So if a loan officer wants to actually cut a price, he's got to go through layers. This loan officer's got to go through sales manager to secondary, right? And then back to the sales manager and back to the loan officer. And the biggest reason why banks don't give lower rates or negotiate, they only negotiate when they have to because of a mortgage broker, right? The loan officers say, oh, I'm getting beat, help me, and then they'll come back and then they'll undercut, right? But they're only going to do that if you force the hand. This loan officer is never going to say, oh, I like you, let me talk to my manager about getting a better deal to start with, right? And then it takes days, it takes hours to get those answers, right? So the biggest thing here is, it's been studied that the cheaper place to actually get a conventional loan is a mortgage broker by over 10K and over 13K by on a VA loan. Okay. In closing, the best place to actually get a mortgage, I feel, and I'm biased, is a mortgage broker. There is more truth in lending and in life, hence the name of my channel, The Till, when you do business with a mortgage broker. If you're not a subscriber, please like, share, and subscribe. I really, really much appreciate it. Talk to you soon.